We are looking at a moment, I think, in corporate history where a company is just hurtling toward $1 trillion valuation.
It's incredible. And with projected revenues of, what, $100 billion by 2027?
It's almost unimaginable. And the entire catalyst for this massive surge, it's a single piece of tech, GPT-5.
And that's the key. This isn't just another upgrade.
No, not at all. This financial scale, backed by what is genuinely revolutionary technology, makes this the most critical AI investment discussion happening right now. Welcome to DeepResearchGlobal.com podcast. I'm an industry analyst here at DeepResearchGlobal.com, and my mission today is really singular. I want to provide you, the investor, with a clear, synthesized analysis of the huge opportunities and the really formidable risks facing this AI powerhouse.
Especially now.
As we get closer to 2026 and this potential public offering that everyone's waiting for. My goal is to pull out the absolutely crucial data points from all the recent material that can really inform your strategy.
It's an essential task. I mean, the complexity here it's just unlike anything we've seen. You have this odd hybrid structure, the bleeding edge tech, the market dominance.
It all happens so fast.
So fast. We're looking at a market leader that essentially controls the new foundational layer for a general purpose technology. We have to really dissect whether that technological lead is actually defensible enough to sustain these staggering projections.
Exactly. So let's start there, right at the foundation. The strengths and the technological leap that has driven this valuation into the stratosphere.
Yeah.
At the very core of this whole investment thesis, the reason we're even talking about $1 trillion is GPT-5. Specifically, that August 7th, 2025 release.
Right.
The analysis we've seen doesn't just call it an incremental step. It labels it a quantum leap. I think it's vital we detail with real specificity why this model is seen as such a premium asset.
And the measurable results, they really provide that validation. The conversation is moving past just conversational fluency. We're now in the territory of quantifiable reasoning and reliability. And those are the twin pillars for any real enterprise adoption.
So let's look at the benchmarks, the academic ones.
Okay, so on the AME 2025 mathematics benchmark, GPT-5 achieved an incredible 94.6% accuracy.
And the critical detail there.
The critical detail is that it was done without tools. No external calculators, nothing. That alone tells you there's been a fundamental internal leap in its logical processing. We just haven't seen that before.
And for investors watching the commercial side of things, the coding benchmark is maybe even more telling.
Absolutely. It secured 74.9% on SWE Bench Verified. And these aren't simple coding challenges.
No, this is not just spitting out boilerplate code. It's resolving complex real-world bugs. It's analyzing existing code bases. It's performing some really non-trivial changes all by itself.
That high performance is the difference between a helpful little chatbot and a genuine development partner, one that can handle, complex front-end work, better debugging.
And that capability translates directly into enormous enterprise value. I mean, potentially exponential cuts in customer labor costs. You just do more with way fewer engineers.
That's right. And that commercial viability, that brings us to maybe the most critical detail for enterprise reliability. The thing I believe most justifies that premium price.
The reduction in hallucinations.
The drastic reduction in factual inaccuracies or hallucinations compared to its predecessor, GPT-4o, this new model, GPT-5, it reduced those generalized hallucinations by about 45%.
Which is a major improvement on its own.
It's a huge improvement.
And here is where the investment story gets really compelling. For anyone who's prioritizing mission-critical deployments in their portfolio. The internal reports we've studied point to this one crucial detail, when the model is specifically prompted to use its advanced reasoning. So when you ask it to analyze, to synthesize, to logically process data.
Not just generate simple text.
Exactly. The hallucination reduction jumps to an extraordinary 80% compared to the older O3 model.
And we have to stress, that's due to a better model architecture. It just handles multi-step logic in a much more robust way.
That 80% figure, that might be the single most important data point in this entire thesis.
I think it is. Because it's a massive de-risking factor for large corporations that have been holding back. Hallucinations were the pain point. They prevented widespread deployment in legal, finance, engineering.
All the high-value sectors.
All of them. Early systems, they had to rely on these complex RAG systems, retrieval augmented generation, just to try and keep the model honest.
And that often broke down at scale.
It did. So achieving this level of accuracy internally through native reasoning, it just solves the biggest hurdle for enterprise reliability. It validates the tech as a truly superior, high-trust infrastructure.
So if the technology is the engine, then the financial trajectory is the fuel. And it's explosive. It's really unconventional. Let's look at the revenue numbers. In just the first half of 2025, the company generated about $4.3 billion.
Just to put that into perspective for everyone.
That single 6-month period is a 16% increase over its revenue for the entirety of 2024.
That rate of acceleration it's just hard to comprehend, even for us. It means you're seeing rapid market creation and rapid market capture happening at the exact same time.
And if we look forward, you see the ambition. Sam Altman has said the current revenue is well more than the $13 billion they projected earlier.
And now they're targeting what?
$100 billion in annual revenue by 2027.
Astonishing.
I do have to pause there, though, and bring in some skepticism. Every investor needs to think about this. With the immense cash burn we're going to talk about later, isn't $100 billion by 2027? Isn't that less of a projection and more of a necessity to justify the valuation?
That's a very fair challenge.
I mean, how realistic is that against a competitor like Google with all its deep integration advantages?
It hinges entirely on one thing. Can they maintain the technological gap that GPT-5 has opened up? That $100 billion projection is only realistic if the enterprise market keeps moving from pilots to full production.
And if they capture the lion's share of that spend.
Which, right now, thanks to that 80% reliability metric, is exactly what's happening.
What's also stabilizing this growth, in my view, is the surprising diversity in the revenue mix.
Yeah, that's a key point.
The reports show a really resilient model. 70% of current revenue comes from consumer subscriptions. The $20 a month ChatGPT Plus.
That shows strong, sticky consumer adoption. It's a predictable revenue base that acts as a buffer.
While the other 30% is from that rapidly expanding enterprise segment, which is, of course, where the $100 billion projections have to come from.
Exactly. That 70% consumer base gives them a solid foundation that a lot of competitors just don't have. It gives them the capital and the confidence to invest aggressively in the expensive R&D needed for that enterprise segment.
And this leads us to our third point. They're commanding enterprise market share. For an investor, this is what validates the long-term stickiness. It moves the discussion beyond just a consumer novelty.
And the data is it's unambiguous. They hold an estimated 61% share of the U.S. generative AI market. That's domestic dominance right there.
Globally, the numbers are even more impressive. It validates that first-mover advantage combined with the tech superiority.
What's the global figure?
The company's products are used by 72% of enterprises that are currently working with advanced AI.
72%. So if a global corporation is implementing AI at scale, chances are they're using this platform. That is the definition of setting a platform standard.
We also see this confirmed in the adoption data that came right after the GPT-5 launch.
Right, from RAMP's AI index.
Exactly. It noted that after the launch, overall business AI adoption rose to 44.5%. But crucially, the data shows OpenAI was leading that growth.
The release was an accelerant for the whole sector, and they caught the biggest updraft.
The transition from just curiosity to mission-critical infrastructure, it's clear in the paying user numbers, too.
The growth in paying business users is accelerating. They surpassed 3 million in June 2025. That's up from just 2 million in February.
That's incredibly fast commercial traction. It confirms that large businesses, which need high reliability, are prioritizing this platform over all the others. The market is voting with its wallet.
Right. They're prioritizing performance and reliability over potential cost savings from competitors, at least for now.
So when we talk about maintaining that lead, the kind of lead you need for $1 trillion valuation, it's not just about the software today. It's about strategic defensibility.
Securing the future.
How do they secure the compute power to stay ahead in this technological arms race? That brings us to our second section, infrastructure, partnerships, and those platform moats.
The strategic partnerships are arguably more valuable than any cash they could raise because they mitigate the single biggest constraint in this whole race.
Guaranteed access to infrastructure, the GPU crunch.
If you can't train the next model, you lose the race. It doesn't matter how good your current software is.
Okay, let's unpack the Microsoft stake first. That provides the foundation. The reconfigured deal from October 28, 2025, it confirmed Microsoft's 27% stake in the for-profit side.
At a valuation of $500 billion, even back then.
And the value here is so much more than just the capital. It's that deep, preferential Azure cloud integration that guarantees them access to computational resources.
Yeah.
Massive clusters of H100s that a standalone startup could never, ever get.
Absolutely. That access is the first foundational moat. But as an investor, the next move is just as critical for de-risking this whole thing.
Breaking the exclusive reliance on Microsoft.
Exactly. They signed that massive $38 billion cloud agreement with Amazon Web Services, AWS.
So what's the specific investment takeaway there? Why commit $38 billion to a second partner?
It's strategic genius, really. First, it reduces that dependency risk on Microsoft. If priorities at Azure change, they have a crucial backup.
Okay.
But second, and much more importantly, it secures future compute, the state-of-the-art stuff. This deal specifically secures access to NVIDIA's crucial GB200 and GB300 chips.
With full capacity expected before the end of 2026.
Great.
We should spend a moment on those chips. For our investors, why are the GB200 and GB300, basically, why are they currency? Why justify such a huge spend?
These are not just incremental upgrades over the current H100s, the Blackwell architecture that powers them. It offers staggering improvements.
In what way?
In memory bandwidth and, critically, in inter-GPU communication, the NVLink technology. When you're training models with trillions of parameters, the bottleneck is how fast thousands of GPUs can talk to each other.
And these chips solve that.
They solve that. They enable models that are orders of magnitude larger and more efficient to train. In this race, guaranteed access to the most advanced chips is the currency. That $38 billion ensures their innovation pipeline won't get choked by the GPU supply chain.
Okay, let's shift to the enterprise market expansion potential. This is where those $100 billion figures have to come from.
And the market data shows we're still in the early phase. The runway is still immense.
We're seeing this fundamental shift from small pilot projects to real production-scale AI deployments across, 15 different industries?
The A16 CIO survey confirmed it. Businesses are not just tinkering anymore. They are actively, substantially expanding their generative AI budgets for 2025 and beyond.
And when you hold 72% of the global enterprise market,
you are overwhelmingly positioned to capture most of that new spending as it accelerates.
I also think their approach to creating an ecosystem lock-in is really clever, a long-term strategic move.
You mean helping people become AI fluent?
Exactly. And then connecting them with companies that need those skills.
Yeah.
It's a democratization approach that builds adherence not just through software, but through certified training, through human capital.
That strategy elevates them from just being a model provider, which is, that's getting commoditized.
Right.
It makes them an essential part of the global AI talent pipeline. And that dramatically increases switching costs. If your entire workforce is trained and certified on this platform, moving to a competitor is far more expensive than just swapping an API key.
It's a powerful, durable moat. And to maximize that lock-in and justify their premium pricing, they are focusing on vertical specialization.
They have to. Premium pricing is non-negotiable because of the astronomical costs we're about to discuss. Vertical specialization is the only way to get there.
We're seeing that with things like the prompt packs from September 2025, targeting enterprise and government users with tailored workflows.
Exactly. And that deep industry integration makes their services much harder to replace with a generic offering. And for developers, making GPT-5 more friendly with better front-end generation and debugging.
That's just smart platform strategy. They're courting the people who build on top of their models.
And when millions of third-party developers build their apps and their workflows on your foundation model, you create network effects that just multiply. It establishes them as the operating system for the next generation of AI.
Finally, we have to look at international growth, because this is a massive, untapped multiplier.
The growth disparity data is staggering. By May 2025, the adoption growth rates in the lowest income countries were over 4 times those in the highest income countries.
So there is massive, high-velocity, untapped demand in emerging markets.
For the investor, that translates into a significant, sustained runway for growth. Strategic expansion into Asia, Latin America, Africa. It presents an opportunity to multiply the user base far beyond what we've seen in mature markets. They are nowhere near global saturation.
Okay, so now we have to address the other side of the coin. The single biggest constraint, the massive cash burn.
This is the profitability puzzle, and it is a genuine structural weakness despite all that massive revenue.
The numbers are they're stark. In the first half of 2025 alone, the company burned through $2.5 billion in cash.
And the R&D expenses.
Colossal. $6.7 billion, plus another $2.5 billion in additional operational costs, mostly for serving the models.
That level of spending means you are constantly balancing aggressive growth against these astronomical computational costs. The core cost of goods sold is one of the world's most expensive resources.
Advanced compute and power. It makes sustainable profitability an extraordinarily difficult thing to achieve,
which necessitates a very aggressive mitigation strategy. And thankfully for them, the only feasible solution is an internal one. It's the technological innovation in GPT-5 itself.
We have to spend time on this efficiency lever. The model is designed to generate comparable results with 50 to 80% fewer output tokens.
Let's clarify that for the investor. What's a token, and why does reducing them matter so much financially?
Think of a token as the basic unit of operation, like digital mileage. When the model generates an answer, it consumes and generates these tokens, and every single token costs money.
It requires computation, electricity, hardware time, and when you're serving millions of queries an hour, that cost adds up to billions a year.
So generating results with 50–80% fewer tokens is like instantly cutting the fuel bill for every single customer query in half, or even better. It is a massive, immediate improvement in unit economics.
And that's their main lever for getting to profitability. If they can serve millions of users at half the cost per query, they can close that margin gap even while R&D costs stay high.
It's a technological solution to a structural cost problem. However, we also have to consider the risk from their organizational complexity, their governance.
JP Morgan analysts were very pointed about this. They raised concerns about rising talent and litigation risks and strategic uncertainty related to that unconventional structure.
This hybrid structure, a nonprofit overseeing a hyper-growth for-profit arm, it's unprecedented at this scale.
And the conflict is inherent. It's structural. The nonprofit safety mission demands caution, expensive research, sometimes slowing down.
While the for-profit side, backed by investors who want an IPO return, needs aggressive growth, speed, maximize returns.
That tension impacts strategic clarity. It impacts leadership stability. Investors are asking what happens if the nonprofit board decides the for-profit is moving too fast.
And any perceived instability could see key talent, key researchers, defecting to more conventional competitors like Google or Anthropic.
So given these costs and governance challenges, the strategic imperative is clear. They have to accelerate the path to demonstrable, scalable profitability.
Which requires more than just the tech leap of GPT-5. They have to optimize their pricing tiers ruthlessly, disciplined cost management across the board,
and a relentless focus on infrastructure efficiency. They can't just rely on top-line growth no matter how explosive. They have to show. Then you have focused competitors like Anthropic, backed by Amazon. They're targeting a $9 billion annualized revenue rate by the end of 2025.
And their Claude models have a reputation for safety that appeals to risk-averse enterprise clients in finance, insurance, medical.
They're carving out a valuable niche by targeting compliance and risk mitigation over pure performance.
And finally, we can't ignore the existential threat of commoditization. And that's largely driven by Meta's open-source llama models.
Meta's strategy is fundamentally disruptive. By open-sourcing highly capable models, they threaten to flood the market with high-quality, free alternatives.
They might lag a bit on cutting-edge performance,
but they're good enough for a huge range of use cases at virtually zero cost, and that directly challenges OpenAI's ability to maintain premium pricing.
Let's pivot to legal and regulatory risks. This is a severe threat that could force changes to the entire business model.
The legal environment is getting more and more hostile. We saw the report from October 28, 2025, where they lost their bid to dismiss part of a copyright lawsuit from U.S. authors.
But the landmark case, the big one, is the New York Times v. OpenAI. It alleges the unlawful use of millions of articles for training the models.
And the potential outcomes here, if they lose, are just catastrophic for the business model.
Rulings could force them to license content going forward. They could be forced to pay billions in damages for past usage.
Or, in the worst-case scenario, the courts could require them to scrub their trained models, which would be a technological disaster. Any of those outcomes hits their costs and their valuation hard.
And beyond copyright, there's global regulation. The EU's AI Act proposed U.S. regulations. It's a complex compliance environment.
And it imposes significant costs and slows down their crucial global expansion plans.
Finally, we have to return to infrastructure constraints. The partnerships are a strength, but the dependence is also a major threat.
The race for GPUs is a real supply chain vulnerability. There are real concerns about them running into capacity issues, material instability in its business or infrastructure because of the scaling demands.
And their ability to maintain that technological advantage from GPT-5 is entirely dependent on securing priority access to NVIDIA's best GPUs, those GB200s and GB300s.
Even with the big deals, competition is fierce, supply is tight. A major disruption in the supply chain, a geopolitical event. It could choke their ability to train the next model. That hardware dependence is a central, persistent constraint.
So we've synthesized the analysis: the transformative tech, the commanding market share, the exponential growth, balanced against astronomical costs, fierce competition, and critical legal threats. This brings us to the final investment outlook.
The trajectory points toward an almost inevitable liquidity event. Reports suggest they're considering filing with regulators as soon as the second half of 2026.
Aiming to raise at least $60 billion, at a valuation approaching or even exceeding $1 trillion.
For the investor, a public debut provides crucial capital for R&D and expansion. It provides liquidity for early investors and employees, which is key for talent retention.
The public markets also bring the pressure of quarterly earnings reports.
And that short-term pressure could create immense conflict with the long-term, expensive, unpredictable nature of AI safety research. The very thing the nonprofit was set up to prioritize, that tension will be a constant conflict once they're a public company.
Let's summarize the final balance sheet for the investor making this decision.
On the overwhelmingly positive side, transformative technology in GPT-5, backed by real benchmarks, especially that 80% reasoning accuracy.
Undeniable market dominance, 72% of global enterprises, and partnerships that secure the necessary hardware.
But the crucial challenge is translating that tech lead into sustainable profitability, all while navigating existential competition from giants like Google and the relentless margin pressure from open source.
And they have to manage their internal governance and resolve those fundamental, outcome-defining legal challenges around their training data.
Their ultimate success and the justification of that trillion-dollar number, it all hinges on whether the efficiency gains in GPT-5, that critical 50 to 80% reduction in token usage, can outpace the astronomical cost of operating this infrastructure.
The next 18 months leading up to that potential IPO will be absolutely pivotal. They will determine if this company can consolidate its position as the defining AI company of our generation.
Or if it struggles to maintain its advantages as the market matures and competition just intensifies dramatically.
Ultimately, I think this investment is about more than just one company's fate.
It's a real-time, high-stakes experiment. An experiment in whether truly transformative AI can be commercialized responsibly and sustainably under this kind of intense financial pressure and regulatory scrutiny. The stakes, as Sam Altman himself has noted, involve shaping the fundamental infrastructure of how humanity augments its own intelligence for the next 100 years.
Thank you for listening. Subscribe to deepresearchglobal.com for more latest business news briefs, company analysis, and investment insights.